So if you plan to leave money for your spouse or your children, then you have to know this, because this is super important, because I know it's something that maybe you don't like discussing, but it is extremely important. But when the accounts are treated very differently when they pass to your beneficiaries. So the inherited traditional IRA, inherited Roth IRA, and inherited taxable.
Yeah, we always talk about trust, which we do a lot of that. I was talking about wills and beneficiaries, right? But you have to understand, well, how do they get the money? What happens to that money? And as Ashley was saying on there, there's the inherited IRA, which, and let's say an example, if my spouse received that, she's still going to be taxed on that money. It still is an IRA, as inherited. So when she takes money out of the account, she's taxed with that. And not to mention, if you are married and that spouse dies, you go from a married filing status bracket to an individual tax bracket, which does cost more. Now, you also want to be aware of the inherited Roth IRA. She gets that as well. She takes out qualified withdrawals from an inherited Roth IRA. There's no tax to her.
Right.
So that can help her out in a better tax situation. Then there's the inherited taxable, that taxable brokerage account, which gets that step up in basis. So there is no tax that is on there on those gains. And it's also the only account that doesn't force you on when you have to take it out. The inherited Roth IRA and inherited IRA typically have a 10-year rule. You must deplete that inheritance, whereas the taxable one does not. And again, check your own state. States can